The doors slammed open with a loud bang, reverberating through the long corridor. The air was filled with shouts as reporters and aides scrambled to get closer. The cameras flickered and flashed, capturing the intensity of the moment. In the midst of it all, Scott Bessent, the Treasury Secretary, burst out from behind a closed-door briefing. His tie was crooked, his papers clenched tightly in his hand, and his face was flushed red with anger. He wasn't simply walking through the hallway. He was storming through it, as if the weight of the world was on his shoulders. As he made his way past the reporters, he dropped a chilling 5 words that froze everyone in place. "We sent the letters 100. In that instant, the room knew these weren't just simple letters. They were an ultimatum, a declaration of power. There was no room for debate, no invitation for diplomacy, just a harsh, cold demand aimed squarely at the world. The message was simple: renegotiate trade under the U.S.'s terms, or brace for the kind of tariff rates that hadn't been seen since the 1930s. According to Bessent, these letters would force tariff rates back to levels last seen in April of the previous year, with some as high as 50%. But as the world braced itself for the fallout, a glaring contradiction emerged. While Bessent's words rang out with authority, there was a key point being overlooked. None of the countries on the list had agreed to talks in the first place. Vietnam, Korea, and Mexico had all expressed their reliance on U.S. exports and were, to an extent, open to negotiations. But the majority of recipients of these letters remained silent. No responses, no public outcry, no sign that they cared at all. The silence, in fact, spoke volumes. The implication was clear. These countries either didn't believe that the U.S. would follow through with its threats or had already moved on from the outdated notion of relying on Washington. According to Bloomberg's global trade trackers, over 63 countries on Bessent's list now did more annual trade volume with China or India than with the U.S. It wasn't a political issue, it was simply arithmetic. Why would these nations negotiate a one-sided deal with Washington when they were already benefiting from more favorable trade terms through the BRICS group? What was particularly concerning about the timing was that President Trump had already delayed the tariff trigger on more than one occasion. The original deadline was set for July 7th, then pushed to August 1st. Now Bessent was calling it a signal rather than a firm deadline. But markets were quick to react. The S&P 500 dropped 2.1% in a single trading day after Bessent's comments hit the Bloomberg terminal. The issue wasn't the tariffs themselves, it was the chaos surrounding them. The market had already been rattled by a $3.4 trillion tax expansion passed only weeks earlier, raising fears of debt-driven inflation that could destabilize the economy. There was no clarity, just a series of warnings that weren't landing, leaving trade partners unresponsive and unsure of where the U.S. was headed. Meanwhile, a second front opened in the form of BRICS. Trump's latest directive imposed an automatic 10% penalty tariff on any nation that aligned itself with the anti-American stance of the BRICS bloc. But the term anti-American remained undefined. What exactly did that mean? Was it dollarization, joint infrastructure projects, or multilateral settlements? The ambiguity was staggering. Under this logic, even Germany, a close NATO ally, could face penalties for engaging in trade with China, settled in a currency other than the dollar. Brazil, too, could find itself facing double penalties for participating in BRICS' reserve asset program, which aimed to settle trade in commodities like oil or lithium using a shared non-dollar instrument. This was not a line drawn in the sand, but rather a constantly shifting target. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Ironically, this pressure campaign by the U.S. revealed a much deeper issue. The U.S. itself had been instrumental in building the global trading system that it was now seeking to undermine. The World Trade Organization, WTO, the International Monetary Fund, IMF, SWIFT, and even bilateral free trade agreements, these were all institutions that Washington had built, funded, and policed for decades. Yet now, with the rise of BRICS, these frameworks were being turned against the U.S. The interdependence that Washington had once championed was now acting as a constraint. What Bessent had referred to as a trade strategy was starting to look more like a containment doctrine, one with no clear boundaries. This wasn't diplomacy, it was a forced alliance, with a ticking clock and no real direction. When you looked at the raw numbers, the scale of the situation was even more evident. Back in 2000, the G7 nations accounted for 70% of global GDP. Today, that number had dropped to just under 43%. Meanwhile, BRICS had risen from 18% to 34%, and that number was still climbing. China alone was projected by the IMF to account for 19% of global GDP by 2029. The potential expansion of BRICS, with nations like Indonesia, Egypt, and Saudi Arabia possibly joining by 2026, could push the bloc's control over global productive capacity to 46% and over half of the world's critical mineral output. In such a shifting global landscape, how much leverage did a tariff letter really hold? Washington might still claim its consumer market was unmatched in size, but that leverage had a flip side. U.S. importers relied on $3.1 trillion worth of foreign goods each year. China, despite ongoing trade frictions, remained the #1 source for U.S. electronics, batteries, pharmaceuticals, and auto components. Yes, Besant's tariffs might hurt foreign exporters, but they would also hurt U.S. producers through higher input costs, fractured supply chains, and retaliatory actions. Retaliation was no longer hypothetical either. In 2024, China and BRICS trade hit 4.6 trillion yuan, about $650 billion US, a 5.2% increase year on year. Despite recession signals in Europe and rate hikes in the US, trade continued to grow. If even a mild trade realignment occurred due to these penalty tariffs, U.S. allies could be forced to reroute their supply chains toward BRICS, and once that pivot happened, it would likely be irreversible. The irony was that Washington's own actions were accelerating this shift. Over 37 countries had formalized alternative trade pathways outside the dollar since 2023. Brazil and Argentina were clearing over 40% of their trade with China using currencies other than the dollar. This wasn't theoretical, it was already happening. The dollar's demand was steadily weakening, and with it, so was the U.S.'s financial influence. Even as this was unfolding, China wasn't simply divesting, it was accumulating gold. In June alone, the People's Bank of China added 70,000 troy ounces to its reserves, bringing its total for the year to over 34 metric tons. This wasn't about seeking higher returns, it was about trust. Gold didn't carry the same risks as the U.S. dollar, and that was why it was becoming so attractive to BRICS. Europe, too, was beginning to shift. In a rare move, a German church pension fund allocated $50 million to a Hong Kong-based China equity fund, signaling a shift of capital into markets that the U.S. considered adversarial. Meanwhile, the BRICS bloc quietly absorbed Western capital, and markets were taking note. The Hang Seng Index had risen 21.3% year-to-date, while the S&P 500 lagged at just 6.7%. This didn't indicate a collapse of Wall Street, but rather a sign that capital was diversifying away from the U.S. In this evolving landscape, Besant's tariff strategy seemed like a last-ditch effort to preserve a fading system, while BRICS was quietly building an alternative one. If the U.S. continued to threaten rather than compete, it might find itself isolated not by tariffs, but by the weight of economic gravity. The question now was whether BRICS would back down, whether Trump would recalibrate, or whether the world was witnessing the final fracture of the old trade world. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.